What choices do you make as a chart setup unfolds? For instance, if you decide to take a long position after observing bullish price action forming on the chart, what's your reaction once the trade moves in your favor and you secure a profit? And how do you respond when the market triggers your stop loss instead? These factors reveal a lot about a trader's psychology and overall mindset. Whenever a new or beginner trader enters the market, their main focus usually revolves around a specific price action strategy, chart formation, candlestick pattern, or trading indicator. After memorizing it quickly, they jump into trades hoping to earn profits right away. When the trade moves against them, their entire mindset gets shaken. In contrast, professional traders, after mastering all the technical aspects of trading step by step, spend most of their time developing mental discipline and reinforcing their psychological strength. This gives them a completely new outlook on analyzing and interpreting the same chart. So, if your goal is to evolve from a beginner to a professional trader, you must adhere to some key principles mentioned ahead. Only then can you achieve consistent profitability in trading. But before we proceed, if you're finding value in this content, make sure to hit that like button. And if you're new to the channel, don't forget to subscribe and enable notifications so you never miss our latest uploads. I'll see you right after the intro and disclaimer. Rule number 1. Manage your emotions. If you master emotional control, no one can prevent you from becoming a successful trader. Imagine this: after spotting a bearish price action, you enter a short position right below the low of this candle. For a short while, you see some profit, but then the price reverses and hits your stop loss. Right after your stop loss gets triggered, the market drops again and reaches your target. Later, as the price rises and breaks the neckline of the head and shoulders pattern forming on the chart, you decide to go long. But just like before, the market dips again and hits your stop loss. Now, since the market has caused 2 consecutive losses, your emotions start taking over, and you begin forcing trades just to recover your losses. At this point, your focus shifts from making the right decision to chasing recovery, leading to even more losses. On the other hand, a professional trader stays emotionally composed and studies the chart carefully to understand why the stop loss was triggered twice. They analyze the reasons behind it and adjust future trades accordingly. You must realize that no matter how skilled or experienced you become, it's impossible to profit every single day. On the days you take a loss, your long-term success depends entirely on how well you control your emotions and protect your capital for upcoming trades. Never let your previous trade outcome influence your next entry decision. Only by doing so can you truly evolve into a professional trader. Always treat both profit and loss with the same mindset. Rule number 2. Always follow your trading plan and stay committed to it. There's only one simple formula to become consistently profitable: identify your trade setup, execute your entry, and strictly hold your stop loss. Professional traders repeat this process again and again to build consistent results. You must do the same. For example, take a look at this chart. The market has formed a flag and pole pattern where a resistance line appears at the top, and the price is moving upward from below, forming higher highs. This indicates that if the price breaks the resistance and holds above it, we can enter a long trade on the retest. Once the price breaks through the trend line, retests the breakout, and starts moving up again, we place our stop loss right here and enter the long trade. That means we've executed our entry following step 2. Now, we simply let the market play out, holding our stop loss firmly until our target is reached. By repeating this disciplined process over and over, you can become a profitable trader. So always keep this plan in mind and stick to it without letting emotions interfere. Rule number 3. Accept your mistakes and avoid repeating them. Take a look at this 5-minute. As soon as the market opened, a strong red bearish momentum candle closed below the day's low. Observing this, many retail traders rushed into short positions, but within a few candles, the price reversed upward, resulting in a loss. Whenever a strong momentum candle forms that's larger than previous candles, never enter a trade immediately after it, in either direction. Such candles are often used by operators to trap retail traders and sell options at inflated premiums. Despite this rule, many traders still take trades right after such candles and end up hitting their stop loss. Mistakes like these are common and completely normal in trading. However, what usually happens next is that when traders see a green candle form, they assume the market is recovering and will move higher. Without waiting for the candle to close, they enter a long position, and once again, the price reverses downward, triggering another stop loss and another loss. Repeating the same mistake throughout the day affects your mindset, disturbs your emotional balance, and leads to impulsive decisions. Acting on impulse, you start entering trades randomly, which causes further losses and weakens your psychological control. Making a mistake once is human, but repeating it over and over is a sign of carelessness. It means you're approaching the market like a gambler, not a businessperson. In contrast, a professional trader acknowledges their mistakes, analyzes them, and makes sure not to repeat them. This approach strengthens their mindset and gradually improves their trading performance day by day. To avoid these pitfalls, accept your errors and make a conscious effort to not repeat them. Only then can you truly grow into a professional and disciplined trader. Rule number 4. Focus on the process, not the result. Here's a 5-minute. Right after the market opens, the price moves downward, forming a bearish price action. It briefly touches around 51,000, consolidates for a short while, and then breaks below that level with a strong bearish candle. At this point, many retail traders look to enter short positions, placing their stop loss just above the breakdown candle, anticipating that the market will continue its bearish trend. This can be considered a valid trade setup, since the price was already trending downward and paused briefly before breaking down again. Traders who entered short positions here with a stop loss followed the correct trading process. However, some traders, assuming the market will surely keep falling, enter trades focused only on their profit targets, completely ignoring stop loss placement. After a short decline, the price reverses upward, hitting all nearby stop losses and pushing those traders out of the trade. Those who had placed stop losses already knew the maximum loss they might face. So when the price moved against them, it didn't disturb their psychology. They were mentally prepared for that outcome. On the other hand, traders who entered without stop losses failed to define where to exit their losing trades. As the market reversed, their losses continued to increase. Seeing their losses grow rapidly, many of them panicked and began averaging down, hoping the market would drop again, which only deepened their losses. This emotional reaction severely impacts trading psychology and mindset. That's why professional traders always focus on executing the right trading process rather than chasing profits. This approach makes them less affected by short-term gains or losses. They already know the potential profit and loss before entering a trade. So remember, your primary focus should always be on the process, not the result. Rule number 5. Take regular breaks from trading. Trading is entirely a game of mindset and psychology. It demands full concentration and emotional balance. As long as you stay focused and free from distractions, your decisions will align more accurately with your strategy. Taking short breaks between trading sessions helps refresh your mind, reset your emotions, and maintain clarity, preventing burnout and impulsive behavior. That's it, traders. Thanks for watching this video. Nothing around you changes until you do. Most people wait for the right opportunity. Champions create it. If this video sparked even the smallest shift in how you think or act, tap that like button. And if you're new to the channel, make sure to subscribe and turn on notifications. Because every video here is designed to help you stay sharper, smarter, and more focused. Keep pushing ahead when everyone else slows down. That's where real growth starts. Stay focused. Stay consistent, and I'll see you in the next video.